Hey everybody, Marty Missouri here. Tuesday after hours, November 7th, 2023. Midweek market snapshot. Going to keep it relatively quick today. After sharing some data, we'll talk about market breadth, the S&P 500, the NASDAQ 100 ETF, QQQ. We'll look at small caps again. And once again, yields and the dollar. So I wanted to just touch base with yesterday's SLOOS, so-called Senior Loan Officer Survey, and look at consumer-related data there. Friday or over the weekend when I do the economic update, we'll pull up our chart, I suspect I will anyway, of the SLOOS for commercial and industrial loans. That's a component in our PWA index. But I thought for our purposes today, we'll just really briefly touch on credit conditions for consumers. And on the screen in front of you is the percentage of banks tightening standards for credit card loans. So you can see that actually came off a little bit from last quarter, so it came down. Thing is, though, and it just covers the last two recessions, you can see that we're at really tight levels, essentially recessionary levels. Auto loans stayed the same in terms of percentage of banks that are making it tougher to acquire an auto loan. Now, how about demand? And this is what I wanted to get to. Demand for credit card loans, as you can see, is really dropping, and it's clearly at recessionary levels. Demand for auto loans actually picked up a little bit here the previous quarter, but the last quarter came back down. For GSE, government-sponsored enterprise, eligible mortgage loans, way down, of course, with mortgage rates at 8%, although they came down a little bit this week. That's really going to be a weight on demand for mortgages. And then home equity lines of credit, way down there as well. In terms of delinquencies, and I just borrowed this from Bespoke Investment Group's closing note this evening. During the pandemic, pauses on required payments basically ended delinquencies, of course, on student loans. Those repayments have now almost entirely restarted. But this is good news. Serious delinquency, 90-day plus rates on student loans, which used to be the problem asset class, remain low for now, although repayments didn't resume until, of course, September. Other serious delinquencies are rising, though. Credit card serious delinquency rates are below pre-COVID norms, but they did rise 1.4 percentage points quarter over quarter, 1.8 year over year. 90-day plus delinquencies for other lending are at the highest levels since 2015. Total serious delinquency rates for auto lending remain constructive, while mortgages are similar. But trouble is brewing. The share of loans that are newly delinquent is rising broadly. For credit cards, it's the highest since Q3 of 2011. For auto and other loans, newly delinquent loans are back to pre-COVID norms, while they're historically low for HELOCs and mortgages, with the latter, mortgages rising. Finally, we note that credit utilization, owed debt as a percentage of available balance, is rising. So people are using those available balances steadily for credit cards, a sign that the consumer is taking on more debt than is healthy. While home equity lines of credit utilization is also starting to rise for the first time since the mid-2000s, albeit at much lower levels. We know what happened around there in the mid-2000s. So I would say the character of the credit, consumer credit, in the economy is deteriorating. And of course, that's one of the signs we've been looking out for. Now, I talked recently about the tale of two consumers. People are spending buku bucks on concerts and cruises. And this just essentially says that higher income households have been driving U.S. spending growth. And that's this cohort right here, much more so than the rest. So we know that. And we're looking at some of the retail earnings call comments. That people are really changing their preferences and essentially where and how they're spending their money. And then just lastly, because I've got it here, the employment diffusion index for the last month. This would be the share of industries adding jobs is really falling off a cliff here. So 52% of industries are adding jobs, right? And you can see, there's the great financial crisis. There's COVID. So we're getting at concerning levels there as well. So, folks, that's just touching base on some things that have our attention. Not all the news is bad out there, but I wanted to show you things that are clearly suggesting that recession risk is certainly on the rise. If you didn't catch the morning note, I talk about where stocks bottom from a valuation perspective at the bottom of the last 3 recessions, and we are considerably higher than that. Hence, we're hedging and staying pretty liquid and being defensive in a lot of the things that we're doing. Okay, so 7th day in a row rally for the S&P 500. We've been talking a lot about breadth. It's improved in our longer-term breadth indicators, a percentage of companies above the 50-day moving average and things like that. The advanced decline line on the NASDAQ still looks horrific to me, as I've shown you a few times. But this is just today, and the same thing yesterday on a rally. So the Dow was up, but 16 of the 30, so more than half of the stocks in the Dow were actually down, decliners on the day. S&P 500, 292, so over half, almost 60%, actually went down on a day when the S&P was up a little bit. NASDAQ was up pretty good chunk, but 1,457, so a little more than half of the stocks are actually down. So typically a healthy market is one where most boats are rising with the tide. We've had too many days where we just get more of that very narrow concentration in terms of the winners. The whole Magnificent Seven story, you take them out and the S&P is down on the year. You take them out of the Russell 3000 and the remaining stocks as a group are down on the year, or at least they were a couple days ago. So just, not something that you feel real good about if you're a bull. Like I said here last week, I don't recall anything remotely this narrow since we managed our way through the tech bubble burst, right, leading into that. So that's not necessarily my forecast, although if you look at just my very simple valuation analysis on the written blog this morning, stocks are, they've got a fair piece to go just to make sense from a valuation standpoint, if indeed we do enter recession next year, which remains our base case. Okay, so as for the technicals, looking at the S&P 500 daily chart, I don't think we need to look at much else. Impressively, we got that rally. We called for that in here. It was an easy call to make, just intense bearishness, and the technicals, it just looked really good right here. A lot like the beginning of October, although we've gotten much more of a bounce, pretty much just pushed back on that entire, second half of October decline. But, stopping right here, pretty much right now at the previous high, maybe just a little bit below it or just right on it. We do have this very distinct downtrend line that looks like overhead resistance to me. Would take you right about to 4,400-ish. But like I said, rally was coming, and frankly, it could have the kind of momentum that could take us to the end of the year without coming back and at least testing this very near-term low. But we'll see. It's not an easy call to make, but it wouldn't surprise me at this point. As for the NASDAQ 100, or at least the ETF that tracks it, we closed right on that downtrend line here. So tomorrow will be interesting. Didn't quite take out this high. We're pretty much right on it, I would say, at this point. That would be a bullish development if you could get through there with some momentum tomorrow. What you'd look for is to come out of that, come down. Either you test that, right, and that would be bullish, or you break down, and that would be a whipsaw or a failed breakout. If we get above this high up here, you'd need confirmation, and you probably would get it. This is a buy signal, and from this stage on the chart, that's pretty bullish, right? And again, looks like looks a lot like the pattern starting in October. We got a pretty nice rally the first part of October. And again, not a horrible looking chart. I wouldn't say this is resoundingly bearish at this point, but it's going to be interesting. Okay, so small caps. I talked about the simple concept that gaps always get filled. Of course, that doesn't always happen, but it happens a lot of the time. And here, here's where we gapped lower, came up just enough to fill that gap, and then boom, bottom kind of fell out there near term. So didn't quite touch the 50-day moving average. Big down candle yesterday, down today as well. Here's that gap area. So if you played this well and you traded that well and you're out, Or if you're short, you might want to cover a little bit, or you could go long in here. Next step would be the top and the bottom of this little gap right here. Really short-term stuff, folks. Ultimately, in a recession scenario, stocks will anticipate that when the market believes that it's ultimately true, that it won't be a soft landing. And then when you look at the correlation of stocks to yields, again, remember, we were basically calling this pattern right here as being something that would be very bearish for yields, bullish for the price of bonds, right? And it's still the setup. So we broke down with some momentum here. Again, lower yields corresponds with higher stock prices, the way things are trading right now. Ultimately, in a recessionary scenario, this happens with stocks going down at the same time. The dollar, recall that technically we got bearish the dollar. We went from neutral to bearish in our equity market conditions assessment, but we got a couple day bounce here. Today was pretty big for a while. It did fall back below the green line here. And for currencies, sometimes I'll look at both the simple and the exponential. And you can do this with anything. But they do tend to be important levels here. And you can see that the dollar literally stopped dead in its tracks at the simple 50-day moving average and closed just below the exponential 50-day moving average. But we'll see. The technicals to me still look notably bearish short term for the dollar. We have a recession. Certainly the U.S. dollar is a safe haven. People tend to flock to treasuries, so that would be bullish the dollar for a while. Although as we meander in that direction, right, and as the data continue to wane, well, then that's going to put lower pressure on yields, and to the extent that the dollar is trading on interest rate differentials between us and other countries, well, then that would be a weak dollar set up until panic happens, essentially. Our long-term thesis, we think the dollar will trend lower over the long term once we get past whatever's left in the cycle. And by the way, that's a very investable environment, but it's going to be different, we think, than what the last bull market had in store in terms of the places to really see long-term sustainable gains. So folks, I think I'll just do a hard stop right there. Hope that was helpful or interesting to you. Thank you, as always, for watching and listening, and I'll be back with the market update and the economic update at the end of the week and or over the weekend. Take care. Thanks again. Bye-bye.